Have you ever wondered how some fintech startups seem to come out of nowhere and start making millions, sometimes billions? Think about apps like PayPal, Revolut, and Stripe. They don't own banks, they don't have branches, but they're changing the way money moves around the world. Now here's the real question. If you wanted to start your own fintech company, how would you do it? And more importantly, how would you make sure it actually makes money? That's what we're breaking down today. The beginner's playbook for starting the right way. I'll walk you through the 5 most popular fintech business models. In sample English, no tech terminology, so you can see which one fits you best. And then I'm going to tell you this, the one step that every successful founder takes before they even write their first line of code. And why skipping it could kill your dream before it starts. Trust me, this one could save you months of trial and error. What is a business model in fintech? Let's start with something simple. A business model is just your game plan for how you'll make money. In fintech, it's the map for how you'll create value for customers, deliver it, and get paid for it. But here's the tricky part. Fintech isn't like opening a coffee shop or a clothing store. You're dealing with money, other people's money. That means strict regulations, security requirements, and customer trust that you have to earn and keep. Pick the wrong business model in fintech, and you could be fighting uphill against compliance issues, high costs, or a market that doesn't want what you're selling. Pick the right one, and you could scale globally without needing a physical location in every city. All right, let's talk about the 5 popular fintech business models. 1. The marketplace model. Imagine an online meeting place for buyers and sellers. You don't own the products, you just connect the people and take a cut from each transaction. Think of it like Airbnb, but for financial products. Maybe you're connecting investors with small businesses that need loans. The pros? It's scalable and flexible. You can serve a wide range of customers. The cons? You have less control over quality and your whole reputation depends on the people using your platform doing things right. 2. The payment processor model. This is all about moving money safely and quickly. Companies like PayPal and Stripe built billion-dollar businesses by helping merchants accept payments online. The upside? It's steady and predictable. Every transaction earns you a fee. The downside? You're dependent on bank partnerships, and fraud is always a risk you have to be ready for. 3. The alternative credit and lending model. This one is exciting. Instead of using traditional credit scores, you use other data to decide who can borrow money. Maybe it's their online transaction history, their utility payments, or even their mobile phone usage. The benefit? You can serve people who've been ignored by traditional banks. The risk? Higher defaults if you get the risk calculation wrong. And trust me, regulators will keep a close eye on you. 4. The neobank model. A neobank is a bank without branches. Everything is online, from opening an account to paying bills to getting a small loan. These can grow fast because they don't have the overhead of physical locations. But here's the trade-off. Customer acquisition can be expensive, and it may take years before you're profitable. 5. The robo-advisory model. This is where you let algorithms do the work. Customers input their goals, and the system invests for them automatically. The big plus? It's scalable. Software can handle thousands of clients without hiring more people. The challenge? It's competitive, and some customers still prefer a human they can call. Now you might be thinking, which one should I choose? The answer depends on 3 things: your skills, your resources, and your target market. If you have a strong tech background and want something lean, a marketplace or robo-advisor could work. If you have banking connections and want a predictable income, payment processing might be your lane. If you're passionate about financial inclusion, alternative lending could be a mission and a business. And if you want to build a brand that customers see as their bank, a neobank is the way to go. Just be ready for the long game. Whatever you choose, remember that in fintech, regulatory compliance is not optional. You'll likely need licenses, follow KYC, know your customer rules, and meet AML, anti-money laundering standards. If you ignore this, your business could get shut down faster than it started. All right, now I want to talk about the step most beginners skip, and it's the one that can protect your entire business, forming your LLC. Why does this matter so much in fintech? Because you're dealing with sensitive financial data, customer funds, and contracts. If something goes wrong, and in startups, something always goes wrong, you want legal protection between your personal bank account and your business. Without an LLC, a lawsuit or debt could hit your personal savings, your home, or even your car. With an LLC, your personal assets are protected. But here's the catch. Doing it wrong is almost as bad as not doing it at all. Registering in the wrong state, forgetting a registered agent, or missing annual compliance filings can lead to fines or your LLC being dissolved. That's why I tell every new founder, let the experts handle it. If you're looking to set up your US company within 24 to 48 hours, let Byz do everything for you. I've partnered with them to get you an amazing deal, more than $250 in savings you can put right back into your new business. You'll get a registered agent service free for a year, unlimited email and phone support, a free 30-minute business tax consultation, and next-day processing. They'll do a name search, draft your articles, and file with the state in one business day. And you can start for just $0 plus state fees. The link's in the description, use it. Once again, here's the simple beginner's checklist for launching your fintech startup. Step 1. Validate the problem you're solving. Don't build an app and then hope people want it. Know they want it. Step 2. Choose your business model and refine it until you can explain it in one sentence. Step 3. Form your LLC so you're legally protected and ready to open accounts, sign contracts, and work with partners. Step 4. Secure any licenses you need. Step 5. Build your MVP, your minimum viable product, and start testing with real users. Step 6. Market, launch, and improve continuously. So here's the takeaway. Choosing the right fintech business model is step 1. Protecting that business with the right legal structure is step 2. Skip either one, and you're building on shaky ground. Now I want to hear from you. Which of these fintech models excites you the most? Drop it in the comments. If you found this helpful, hit that like button, share it with a friend who's into startups, and subscribe so you don't miss my next video. And remember, if you're serious about starting, get your LLC done right. Use my Byz link in the description to start for $0 plus state fees, protect your future, and launch with confidence. Your fintech dream is waiting. Let's build it the smart way.